Good afternoon to our audience. We'll just allow for a couple more minutes for anyone else to join today's webinar. Thank you. Good afternoon to our audience this afternoon, and thank you for everybody for joining us. And I'd just like to start by thanking all of you on today's webinar who have been investors in the Lucerne Alternative Investments Fund, that are known to most of you as LAIF. Not only those that have joined the fund recently, but those that have been invested within LAIF for a long period of time and over the journey. Particularly in light of 2022, which was a pretty difficult environment for most markets out there. So we do thank you for your continued and ongoing support, and hope to see returns deliver for our investors in 2023 and beyond. So first of all, we're just going to share our standard disclaimer with you. Just some basic housekeeping matters before we get started. So my name's Anthony Murphy. I'm the founder and CEO of Lucerne, and also sit on the investment committee for LAIF. And I'm joined today by CIO of Lucerne and Chair of LAIF, Michael Houghton. And again, thank you for your time today. The webinar will run for approximately 45 minutes. 30 minutes of that will be Michael and I presenting, and then we'll have 15 minutes for Q&A. A copy of today's recording and presentation will be sent out to all those that are subscribed to today's webinar. The session is being recorded. Per usual with our presentations, the Q&A section can be found either at the top or the bottom of your screen on Zoom. You can submit your questions there, and we'll look to address them at the end. We do have quite a large audience attending today's webinar, so any Q&A that we don't get to, we'll be sure to follow up directly with you. So again, thank you for your time.
Okay, thanks Anthony, and welcome everybody. My name is Michael Houghton. The Lucerne Alternative Investments Fund, it's probably worth just recapping briefly what it is and why it's for investors who are particularly interested in the alternative space, because it does solve the problem of access to genuine alternative investment options. And it does also provide liquidity, being monthly, and that's a pretty rare, if not difficult thing to find within the investment market, particularly for investors who are wanting to have a good, diverse, well-allocated portfolio. The investment committee for LAIF consists of 4 members. It's a very experienced IC, as you'll see down the bottom of this particular slide, with a combined 100 years of investment experience. LAIF is also supported and managed by a full-time portfolio manager with 2 analysts, and there's also 2 other members of the team that provide ongoing support on an ad hoc basis. The investment strategy for LAIF and the themes is determined by the investment committee. It has a return objective, the fund that is, has a return objective of RBA cash rates plus 6%, which is over a market cycle, and we've exceeded that since inception. The volatility of the fund is a critical component and something we focus on considerably all the time, and that is expected to be approximately half that of equity markets, again, over the cycle. And you'll see later on how we're going, tracking with that particular measure. We also have built, since we started this fund, a proprietary model that is quite comprehensive. It has over 275,000 data points, adds approximately 8,300 a month. That's primarily through the number of managers that we talk to, the data we get from them, plus our own macro research, and also other data points that we consider relevant to help manage and measure what we're looking to achieve. The next slide that we really think is important to talk to, because we all seem to forget things pretty quickly, especially after Christmas. But what happened in 2022, particularly from a macroeconomic and also a markets perspective? The one that's on everybody's tongue at the moment, of course, is inflation. It's at its highest level in 30 years globally. Interestingly, and not unsurprisingly, 30-year low in unemployment. And also China's reopening recently has started to export inflation. And by that, we mean they've been locked down all through 2022 as inflation has started to really tear off. And yet China hasn't been participating in that market. Now they've reopened, now they're bottling some of those supply chain bottlenecks. There's going to be another feed through, in our opinion, into inflation numbers. The other interesting thing is that the US Fed increased rates for the first time in 4 years last year. The Reserve Bank of Australia increased rates for the first time in 12 years. The Fed has now done 8 consecutive increases of rates totaling 450 basis points, or 4.5%, while the RBA has done 9 consecutive increases totaling 325 basis points, or 3.25%. They're significant numbers. There's disparity between both, and again, we'll touch on a bit later why that is. The other thing that happened at the start of the year and then just continued to have ramifications throughout the year was Russia's invasion of Ukraine. That led to a global energy shortage. A really good example of how that energy shortage manifested itself was the fact that Germany had 70% of its gas supplies coming from Russia. This whole the globalization of supply, the globalization of commodities and markets led to these dependencies on one another, and that's where, once something like the Russia invasion of Ukraine took place and countries had to vacate Russia, it created real bottlenecks, real spikes in prices, shortage of goods. It was actually quite a terrible first 6 months, and that was reflected in how the markets behaved. The final point we're making here is there were market crashes throughout 2022. You had the Chinese property debt bubble and the COVID lockdowns that led to some of that, but the Chinese government is very, very focused on trying to bring down the leverage in their system, and property in China has been built predominantly on leverage, and it's not much spoken about or reported, but it is a really big issue. That's been exacerbated too by COVID lockdowns, with a zero infection rate being targeted and disbanded at the end of 2022. But that's also had a significant impact on markets, and then fed through into the equity and bond markets and the crash in prices that we saw there. Further, we saw the crypto crash, wiped out $2 trillion in value. But the thing that I suppose, if there's a silver lining for that, was that it took out all the bad actors. It took out a lot of these centralized exchanges. It took out a lot of people who were operating schemes for their own purposes rather than operating a proper exchange.
So what did 2022 dish up for traditional markets out there? On this chart here, what we're trying to demonstrate here is some of those key indices, but also having a look at obviously what happened with the respective cash rates of the Federal Reserve and the RBA. So on the left-hand side of the chart here, we're charting the returns of the ASX 200, the S&P 500, and the US 10-year bond price, as well as the NASDAQ. And on the right-hand side, we're charting the US cash rate, or the Federal Reserve cash rate, and the RBA cash rate. Focusing first on the ASX 200, the S&P 500, and the NASDAQ, you can see they all had relatively weak years. As we've seen previously in the GFC, the ASX 200 was helped by our resources sector here and didn't decline anywhere near as much as the S&P 500 or the NASDAQ. You would expect the NASDAQ to perform the most poorly out of those three indexes, given the high exposure that index has to growth companies. In good times, the NASDAQ outperforms. In poorer economic times, the NASDAQ tends to underperform those other indices. What's probably most interesting, though, with what happened last year in markets, and our own sovereign wealth fund, the Future Fund, and their CEO and chair have talked about this extensively, is the traditional 60-40 portfolio that investors have relied on for many years. And by way of background, that 60% of your portfolio is weighted to equities and 40% of your portfolio is weighted to bonds, with the idea that in bad times, that 40% allocated to bonds helps the portfolio stabilise and not be as exposed to drawdowns. However, that rule book was thrown out the window last year, and we saw, and you can see on this chart here represented by the red line, that even bonds declined last year by approximately 15%. At one stage, they were down 17%. So the 60-40 portfolio was not immune to the market dislocations that we saw last year, which left a lot of investors scrambling with what do we do then with portfolio allocations if even the defensive part of one's portfolio is not working. And no surprises here, there's an inverse correlation or inverse relationship with both the US cash rate or Federal Reserve cash rate and the RBA cash rate, as those rates have risen sharply, particularly through the middle and the end of last year. We've seen a decline in equity markets as a result. Bear or bull? Where are we in the market at the moment? It's $1 million question everybody's asking themselves. And is the market currently cheap or fundamentally cheap after the drawdowns we had in equity markets in 2022? Was 2022 a market correction or the start of a prolonged bear market? And look, that's a really good question. I think most investors out there would like to think that 2022 was a bit of a clearing of the decks, and hopefully we'll see a recovery in equity markets this year. Speaking to some market analysts that we know quite well over the last couple of weeks, many of them feel that the equity markets returned their entire 2023 return in the month of January alone. We feel, however, at Lucerne, with all the noise and uncertainty that's going on in markets at the moment, and all of that rapid rise in interest rates that we experienced in 2022, we just simply don't know the impact or the fallout from that monetary policy tightening last year. And as a result of that, we're now starting to see unemployment rise. Only a couple of hours ago, our unemployment rate's starting to go the wrong way. We're seeing these large global tech companies starting to lay off staff. So we actually do feel we're at the start of a prolonged bear market, and that's how we've positioned the portfolio of late, which we'll talk to shortly. But what does it mean at the moment from a market perspective? Are we cheap? Are we expensive? Or are we at fair value? Interestingly, the S&P 500 over the journey has had an average PE or price earnings multiple of 15.99 times. So call that 16. Currently, that multiple is trading at 22. So if we think about mean reversion, which is a concept that's often spoken about in markets, if something outperforms, there's a reversion back to mean. If something underperforms, there's a reversion back to mean. Now, quite often with mean reversion, markets tend to overcorrect both ways. So even if we were to get back to that long-term average of the S&P 500, there's a 27% drawdown from where we are currently. And if we apply that to the ASX 200, there's a 15% drawdown. But as I just mentioned, often when we do see a correction, there'll be an overcorrection, and we can go back to the GFC and remember those times as well. So therefore, that's why our thesis stands that we feel we're at the beginning or somewhere through a prolonged bear market. As I mentioned before, the performance of those indices in 2022, the S&P 500 down 19, NASDAQ down 33, and ASX 200 down approximately 5.5%. So how has LAIF performed not only in 2022, but also over a rolling 3-year period and also since inception? How does LAIF stack up against not only the market, but also the Barclay and Eureka hedge fund indexes, which is a portfolio of hedge funds from around the globe, well-known hedge funds. So for calendar year 2022, LAIF delivered a return of approximately 3% per annum. In financial year 2022, LAIF delivered a return of 11% per annum. So we're comfortable and we're pleased that we're able to finish the year in the black. But as we know, LAIF is constructed and designed to be delivering investors returns of the RBA +6 over the cycle, which it has done. And as we move towards the end of last year, we really started positioning the portfolio for the year ahead. What I mean by that is we sort of didn't get caught up in the market rallies of November, October, nor the market rallies of January, and the portfolio is carrying the least amount of correlation with the ASX 200 that we've ever had since inception. What is pleasing for us is the risk-adjusted returns that LAIF is delivering investors. So if you look there at the 3-year return of 14% per annum compared to those other indices, LAIF has outperformed. If you look at the annualised return of LAIF compared to those other indices since inception, LAIF has outperformed. What we pride ourselves on is delivering that outperformance on the downside, not the upside. Most investors always associate greater returns with greater level of risk, whereas LAIF has tended to outperform by taking less risk to those other indices. And what that all means is that LAIF is now returning, since on an annualised basis, a Sharpe ratio, producing a Sharpe ratio of 1.14. And what the Sharpe ratio basically identifies is the level of risk one is taking for the returns that they are getting, that they are receiving. So historically, the ASX 200 has annualised approximately 8% per annum on volatility of about 16. So that produces a Sharpe ratio of 0.5. Since inception of LAIF, our Sharpe ratio has been 0.4. By rule of thumb, a really good long-only equities manager will trade on a Sharpe ratio of about 0.7. A good long-short manager will trade on a Sharpe ratio of 0.9. So anything of 1 or above is considered very strong. The level of risk an investors were taking, they've been well and truly compensated well with that level of return. Noticeably, you can see here the percentage of positive months is actually quite similar when you compare LAIF to the ASX 200 and S&P 500. So we're generating high level of returns in those indexes, but we're also having a similar amount of positive months. So what that does tell you is that when LAIF is experiencing negative months, or those indices are as well, that our drawdowns aren't anywhere near significant to those other indices. And you can see that there, our average negative month, we're down 1.5%, where the ASX 200 and S&P 500 are down 4.5% and 5% respectively. Also, as I mentioned before, our correlation with the ASX 200 currently sits at 0.49, which is the lowest in the fund's life cycle or history, and that's something that we're pretty minded to keep going forward.
So I suppose the next slide illustrates how we've been able to do that. So Anthony's spoken about the performance that we've achieved to date, particularly over 2022, which is important to talk about, but equally important is to talk about what we've done over the last few years and what's contributed to that. So if we look through this bubble chart here, which is how the fund is allocated, and I just need to highlight, quickly, you'll notice that we've got 87% allocated to investments and 13% allocated to cash. We're just in transition at the moment, but that's as of 31 January. There's a couple of investments that we'll be funding over the next couple of days. It'll take that cash level down to about 4%. The contributions are easily identified in this bubble chart with the green arrow showing what was a positive attribution for the fund. So I just need to emphasize, it's not that that fund went up in 2022, its contribution or attribution to LAIF was positive. So we've got across the top line there, our global long short strategies, our US healthcare and consumer discretionary long short strategy, private and public equity, our global quant or trend following strategy, our technology strategy, and our long short resources strategies, all being positive attributions for the fund. And across the bottom there to another private, public to private fund, another long short fund, another allocation to resources, our industrial convertibles, which we'll talk about in a moment, global resources, all being positive contributors. The interesting thing to note there is with the decarbonisation theme, for example, that fund has been a slightly negative contributor. somewhat driven by currency, which I'll touch on shortly. And the Australian event driven is another one we'll talk about, as well as the Australian long short. So each of these funds, though, illustrates one thing that we do talk about often, and that is the fact that having an allocation to many investments and well-selected investments with some very key criteria that are focused on strongly, it allows us to carry some of these injured players, as we call them. We look at the Australian event driven, for example, and the Australian long short, or even the industrial convertibles. Historically, they've been really good attribution to the fund. They've suffered mostly in the back half of 2022 for various reasons, but the rest of the fund has been able to support them and also the return and risk objectives that we have. And I think the next slide that we'll go to.
Just on that, I think a lot of the modelling we do with LAIF is really, we don't want every underlying strategy or manager in the portfolio to be performing well at any point in time. Equally, we don't want them performing negatively together as well at any period of time. So that's a lot of the modelling and data analytics that we do behind the scenes with LAIF, is getting a well-balanced portfolio that delivers, that these underlying strategies deliver overall returns to investors at different points in the cycle. And that's something we've worked really hard on the fund over the last 3 years. And that's one of the key contributors to why the fund has performed the way it has over the last 3 years.
Now, we might spend a little bit of time on this slide because it's illustrating some of the movements that the fund has taken throughout the year. It also talks a little bit to the previous slide, because you might have noticed a couple of those allocations that we've got. Some of them are around 11 and 12, and a couple are around 3 and 4. And while we might be de-weighting some of these investments, we're not always exiting the investments. We're just allocating up or down depending on how we feel they're behaving or reacting to what's happening in the market. So a couple of the ins for the year 2022 were carbon trading, a quant strategy, a global equity long short strategy, a resources strategy and market neutral, volatility, and a technology strategy. On the other side, outs. Now, the quant strategies, we went up early in the year, and then we started to unwind some of that allocation. We've retained an allocation, but we've started to unwind some of it as we started to get towards the back end of 22, and we know how that particular strategy will behave when markets start to whipsaw, which we've seen throughout probably the last 4 months. The other one that I touched on was our industrial convertibles or hybrid credit. That has been a really strong contributor to the portfolio for a lengthy period of time, but the current market isn't favourable for what they were doing, and we've decided that there are better ways we could allocate that capital, and we've actually started to, we've redeemed half, and we've got the other half coming out shortly to go towards those ins that we've been talking about. There's one strategy that I did want to touch on, because you see it appearing across all 3 columns there, and that's the volatility strategy. We believe volatility is something that we can participate in. It's there's the fear index, if you like, in the US is the way it's described. It's called the VIX. We initially, at the beginning of 22, participated by taking out exposure to the VIX. That particular strategy that we did go into performed well for us. We could see, though, that it wasn't quite behaving in the same way that we had expected it would. And we expect, though, and we could see too that some of that strength was starting to, in the VIX, was actually not being matched in the underlying strategy we were participating in. So we unwound that, and that was a good thing to do, because then that fell apart ultimately, because the market maker wasn't prepared to stand behind it. So we could see that starting to happen, and we made that position, that call, sorry, to exit that position fairly quickly. But we are looking at volatility still. It is a theme that we do want to participate in, but we've now found an alternative strategy that we're looking at that will allow us to participate in volatility in a couple of ways. And we think that without taking equity risk, so we're actually going to be participating to get the benefit of equity volatility in some very cheap markets that actually do correlate strongly to what happens in equity market volatility. There's a couple of other strategies in there that we have also got on the watch list, if you like. Emerging markets is one of them. Emerging markets typically are markets that do perform well going through a bear market and coming out of a bear market. And we've been following and talking with a couple of managers for about 12 months now. We don't believe we're there yet, but we think we're getting close. So they're certainly on the watch list. Impact investments, we've spoken about one of the ins for the fund being carbon trading. We have, again, a number of managers and stakeholders that we deal with that have exposure to other sectors of that market that we think are important and fit into our decarbonisation theme. There's also a technology strategy that we went into. I think Anthony talked a little bit about why and what's happened there.
Yeah, look, many of our investors that have been in LAIF for the last few years are well aware that we initially traded that digital assets thematic very well. It realised approximately 8 to 9% for the fund from early 2020 to July 21 when we completely exited that position. We just got, to be quite frank, a little bit scared or sceptical with the digital assets market when church youth groups were setting up crypto trading clubs. That was a pretty good sign. It was probably time to exit. However, just because we exited an asset class, it doesn't mean we're still not interested in that asset class. And albeit 3 months later, at the end of 21, we started doing a lot of work on the seed and pre-seed space in digital assets. So how that would relate to normal markets, that would be sort of the private equity and venture capital space. We found a really interesting strategy at the end of 2021 and did a lot of work with the team that set that up and made our first investment in that strategy for the fund in July 2022. So it was about 6 or 7 months of due diligence. Pleasingly, whilst the rest of the digital asset market really capitulated at the end of 2022, and including FTX and all those other articles you probably have read in the press, our strategy actually made money, and that was because we thought a lot about how we wanted to re-enter that market. And after actually speaking to that manager only about 3 hours ago, I've been informed that there's some material uplifts coming through that strategy in the next couple of quarters. So we'll be pleased to talk about that with investors. I might even invite that manager to speak to investors directly in the next few months. So that's just an idea of something that's worked well for us previously. We're not necessarily going to go back into that fund or that strategy, but we'll look at the asset class and we'll identify what is the best risk-adjusted way to re-enter that asset class on occasions.
Yeah. And we just wanted to highlight here the fact that it's been a strange year for the US dollar in particular, up at one stage probably 15% and towards the back end of the year down 15%. And the fund, though, does have exposure to the US dollar. It has exposure to offshore managers and assets, probably sits at about 35% at the moment. We're very comfortable with those allocations, and in fact, a couple of the new investments we're looking at are also going to be US dollar denominated investments. We don't actively hedge. We want to carry the exposure to the currency and to those assets and those markets. So at times, the currency will be our friend, and at times it will be something that goes against us. But overall, while it does have a small impact on returns, it's still an important part of our investment strategy. And the next slide, I think that we want to just cover off on, because it's an important part of what we do and how we think. You've heard us speak about our themes and the way that we think about the world and where we would like to allocate the capital that the fund has. A reminder, our themes are decarbonisation, inflation, deglobalisation, resources, and geopolitics. A couple of those could be interchangeable, but they each have their unique characteristics. And we've got our strategy day coming up again in a few weeks' time. It may well be that we continue with all of these themes, and it's possible that there might be a substitution or an addition there as well. But what this slide does highlight, though, is how we're either participating in each of these themes with the strategies available to us, or what strategies are on the watch list and that we're actually looking at adding to the portfolio because they will serve a purpose not only within the theme, but also how to play that theme and how to get a positive exposure and positive return.
And I think a really good example around that from many of you out there, we've spoken about our trend following fund for some period of time. For many of you out there, you would know that is ISAM. That is a strategy that we've held in the portfolio since day dot. The investment committee sat down in mid-2021. At the time, that fund ISAM had a weighting of circa 5% in the portfolio. We didn't believe that inflation was transitory. We did feel that energy prices were going to start to increase significantly, as well as agricultural prices as well. They're very strong themes in the market, which tends to suit trend following strategies. So at that time, we increased our exposure to that theme by about 3% of the fund's capital. That theme performed incredibly well for us during FY 2022. And at the moment, you're seeing a lot of trend following strategies now starting to enter the Australian market on the back of good performance. And as investors, we've always been guilty of chasing performance when it's already been realised. Whereas LAIF, we really sort of pride ourselves on identifying strategies before they perform and then exiting them or de-risking exposure to them as they're starting to decline, or that thematic has run its race. And ISAM was a really good example around that. As an IC, we sat down in the second half of last year. The weighting was then reduced from 13 back down to 8%. So whilst others out there are looking to increase exposure to trend following strategies toward the end of last year, we really wanted to lock in that performance, still have ISAM as a decent weighting in the portfolio, but it is a good example of a strategy that we will hold throughout the life cycle of the fund, and we'll increase that weighting or decrease that weighting to reflect our views on whether that strategy is appropriate for the market conditions ahead. So having a look at volatility, which is something Michael touched on at the start, and I think that's really important. Most investors out there, when they think about investing, we tend to find they don't want to suffer a significant drawdown of capital, but they still want to make quality risk-adjusted returns over time. And that's primarily how we've structured and set up LAIF, and it's probably our key focus on an ongoing basis. When markets do dislocate or go through negative periods, are we preserving capital, or are we only participating in a small percentage of that market drawdown? But equally, when market conditions are strong, we want to be able to tilt the portfolio to strategies that benefit from rising markets. So having a look at the last 3 years, you can see how LAIF has performed at different times in the market cycle. And obviously during the last 3 years, we've experienced some pretty interesting times in the market. Starting off in 2020, in February and March, when the pandemic first hit, global indices and the ASX were down significantly. At one stage across February and March, the local market was down circa 30%. During that same period of time, LAIF was down approximately 6%. So we're able to really preserve capital for investors whilst market conditions were seriously dislocating, which allowed us then to compound off a higher capital base. And that's why we could deliver a 20% return at the end of 2020, because we didn't get caught up in that market drawdown, or primarily a minimal amount of that market drawdown in February, March. Then, as we all know, with all the stimulus that have been pumped into the system, our markets basically rallied for the next 12 months. In fact, from September 2020 to September 21, markets just went up. And thankfully, LAIF was also able to participate in all of that market upside. But what we were really preparing for at the end of 2021 and trying to get in front of 22 is that we just did not feel that 2022 was going to be the same sort of Goldilocks environment. So in the last 2 quarters of 2021, we actually started repositioning the portfolio, taking risk off and looking for strategies that we knew historically had performed well in volatile markets, in particular when markets tended to rationalise. And so then we entered 2022, and as we can see here, as market conditions did deteriorate, our real focus was just preserving capital and being able to then reposition portfolios to generate returns, even when it was very difficult to generate returns through traditional methods. So if we think about 2023, we're probably approaching 2023 with a very similar lens of 2022, but also starting to get the portfolio set in strategies that we believe will actually produce quite significant returns for investors in the latter part of 2023 and beyond. And that's a lot of the work that the IC is currently focusing on. So when we talk about correlation with the market, this is the correlation LAIF has held against the ASX 200 since inception. So if one holds if you hold a correlation of 1, you're perfectly correlated with the market. So if the market moves up 1%, you move up 1%. If the market moves down 1%, you move down 1%. If you hold a correlation of -1, you're completely negatively correlated with the market. So across LAIF, we have some strategies that are actually negatively correlated with the market. We have some that are more correlated with the market. But from a portfolio basis at the moment, LAIF is carrying the least amount of correlation that we've ever had with the market. You'll see that there's sometimes some volatile times in that chart, and there's no surprise that when correlation really spiked in February, March 2020, there's that old saying that when markets really dislocate, all asset classes become correlated. So LAIF's correlation with the market jumped up in February and March 2020, but we're able to get on top of that pretty quickly. Within 2 months, we're trending back down again. And so as markets have risen over the past few years, we've been mindful of really taking our reliance on market conditions being healthy in order for the fund to perform. And we expect that trend to continue for the time being. We've been able to deliver quality risk-adjusted returns for investors, as I said before, without taking on more risk. And so when we think about how LAIF, I guess, was outperforming from a volatility perspective up until the end of 2019, you can see that our outperformance in volatility has actually improved over the last 3 years, whilst volatility across the board has increased. So yes, we have moved from volatility in the fund of just below 6% to about 7.7%, whereas over that same period of time, the market's moved from volatility of circa 10 to up to 18, and now that's flatlined out at about 16%. So that's something we're proud of, but it's something that we're really focused on obviously maintaining, and that's to keep producing equity-like returns or better than equity-like returns, but with half the volatility of markets or even less than that. And finally, just showing you some examples here. Since inception of the fund, we just wanted to focus on all those months in which the ASX had drawdowns. Other than May 2022, whenever there has been a down month in the ASX, LAIF has outperformed the ASX. And what we really wanted to sort of, I guess, retest our mandate after the market had gone up from September 2020 for 12 months, September 21. And you can see that there in this chart, there's a bit of a hiatus, so to speak, from September 20 to 21. There's a year there with no ASX down months. So as we entered last year, when the ASX was down in January 22, LAIF was up. When the ASX was down in June 2022, LAIF only participated in about 20% of that 20% of that market drawdown. And then again in December last year, when the market was down about 3.5–4%, we produced positive returns. And that's how we're thinking about the portfolio at the moment on a go-forward basis as well. We really don't want to participate in much market downside. And we also appreciate that most investors out there already have portfolios that hold traditional assets in there, such as equities, bonds, and property. So we understand that part of the portfolio will be more correlated with traditional indices and market conditions. So we understand that LAIF is sort of complementary to those types of investments.
And to finish up, so if you've got any questions, please add them in. We've got a few minutes left. I'll just round out what our key takeaways for 2023 are. We've just concluded an IC meeting this morning. We remain uncertain. There's macroeconomic uncertainty in our view. That actually for us is an opportunity and a challenge. But that uncertainty is, I think, driven mostly by where to from here. There's a lot of commentators, there's a lot of opinions, but the one thing that we're focused on is the dislocation in markets. There just doesn't seem to be any rational reason to support the valuations that we're presently observing. If you think about that slide we had up earlier, where the market in the US or Australia is sitting at 20 to 30% above where the long-term average sits, and yet we're in a inflationary environment that's we haven't seen for over 30 years. We're in an interest rate rising environment that is completely new to people because they've been so used to stimulus for so long. That's where a lot of this uncertainty is going to come from. That obviously is going to create heightened market volatility, and that's something we're observing. And as Anthony has just spoken to, we're very, very aware of what we have to do to make sure that the portfolio doesn't get impacted by the volatility in a negative way. And in fact, as we've said, we're finding ways to participate in what we think will be quite a volatile market across all asset classes, not just equities. So to that end, our allocation decisions today have been pretty much driven to volatility, as we've been speaking about, impact investing, which we've spoken about, and also emerging markets are under consideration. So probably over the next 6 to 8 weeks, we'll have manager meetings. We'll actually do a lot of due diligence and a lot of analysis, and we'll come up with how those particular allocations could benefit the portfolio, in addition to what we think is already a well-structured, well-allocated group of investments.
And one question that we've had from investors of late that also came through before as well is that if there is a bias in investor portfolios across the board, if you think about, passive investing's worked quite well over the last decade as asset prices have just ballooned. But if that's now not going to happen with all the economic headwinds that we do face, is there going to be a greater bias and a shift of capital towards alternative investing? And then does that space become crowded? It's actually a great question. And we've seen some other larger asset managers out there increase their model portfolio allocations in alternatives to 20 to 30% of late. One thing that LAIF focuses on and why LAIF has limited capacity is identifying boutique investment managers that are below the radar, that don't want to be on platform, that don't want to be rated. And in fact, 70 to 80% of our portfolio is in managers that manage up to only a few $100 million, which is quite small in fund management world. So that's probably a differentiator of LAIF that we'll continue to pride ourselves on. It's these managers that are not like your KKRs or Blackstones of this world. It's managers that look to only deal with family offices or private investment groups that only want to manage a finite pool of capital so they can remain flexible and nimble when market conditions change. So we still feel that LAIF will be able to participate within those managers and asset classes and not be crowded out by a greater shift of capital into the alternative space. But because we feel if mandates do change across the board with a greater shift of capital into the alternative space, that's going to be with the larger players, like I said before, and that's just not a part of the market that we tend to participate in.
I think the thing to add to that is, of course, the market, you could argue, is already crowded with alternative investments, but it's down to the skill and the capability of the investment team to identify where to allocate the capital, how to allocate it, how long, how much, and how to manage the risk in allocating that capital to get the returns. It's not a straightforward process. We've been doing this for over 5 years now, and we continue to refine and refine and refine. And it's not as straightforward to allocate just an alternative and hope that it works. And that's a whole other conversation that we're happy to have with anybody who wants to talk about it.
Yeah, it's like Michael said before, we got one of our impact investments. When I say wrong, we went into an impact manager we did a lot of work on about 12 to 18 months ago. As markets started to dislocate, they were carrying far too much beta, and we weren't going to hang around to see if that had changed. So it would change. So we moved out of that position very quickly, and that's the benefit of having the structure of LAIF. We do have a question that's come through. Do you think the Fed government is providing reasonable economic management, or are you concerned? I've gone on the record a few times saying this, that I think the RBA, if you speak locally, I think the RBA should be shot for how they've handled the economy over the last few years. It was completely reckless to tell the country that interest rates wouldn't increase until 2024 and make that statement in 2021. The Fed Reserve and the RBA and global governments or governments around the world, in 2021, we're hoping that the problem we're seeing today was going to go away. They were touting that inflation was transitory, that supply chains would open back up quickly. And we just didn't believe that spin at the time. And instead of getting in front of the problem at the time, they waited for it to become too big, and now that problem's been exacerbated. And that's why you're just seeing such aggressive interest rate rising as a result of that. And many have asked us about where we think rates are going. What the RBA is focused on at the moment is getting to a bare minimum, what's called a cash neutral position. And that's where you have the cash rate come in line with the inflation rate. And at the moment, inflation's around 7, and the cash rate's at 3.35. So you're still miles away from that. And the RBA won't stop until you at least have that equilibrium as a bare minimum. So something probably breaks in the economy, and then when that happens, they might start cutting rates again. So we still think there's probably another 100 to 150 basis points of interest rate rises in this country. Sorry, federal government, not yeah. So just to come back to that question, the federal government managed, not the RBA. Look, I think they're actually quite similar. With all due respect, one thing I'd say the Fed has done better than the RBA, which is how the US tends to act, is they get in front of the problem a little bit quicker. Both when markets come off, and both when markets also rally. And you've seen that time and time again. When markets do rally or recover, the US tends to outperform Australia. But equally on the way down, the US tends to get belted more than Australia. But fundamentally, whether it's the Fed Reserve or whether it's the RBA, they're not going to stop until there is a clear sign of an economic slowdown. And only as recently as this morning, numbers out of the US show that there was record retail spending in January. So people at the moment just aren't getting it. And we are now starting to see unemployment go the wrong way, actually increase. We've got significant amount of residential mortgages that are going to be rolling off fixed rate loans of 2% to 5.5%, 6% over the next 6 months. And to give you an idea of what that looks like, across May and June, there's $45 billion of monthly interest in currently fixed mortgages that are going to be rolling to rates nearly 300% higher. And we just don't know what the impact is on that yet. As a result of that, we don't think it's good, clearly. Therefore, we're still remaining incredibly cautious, as Michael mentioned before.
And I think just to add, there is a fiscal policy element to the response to what's happening. It seems though that at the moment, all the heavy lifting is being left to the central banks globally, and using monetary policy, which is a blunt tool, which is where we could ultimately see pain come from. I think as far as the Australian government is concerned, its first real test and its ability to pull those fiscal levers is probably going to come through in the May budget. They're already starting to plant seeds via strategic press releases or leaks. So we'll just have to wait and see. I think it's just a bit early to see any impact from the fiscal responses at this stage. But certainly the RBA is a great scapegoat every which way, irrespective of how they've actually handled things.
Yeah, as we discussed in the IC this morning, we don't think Mr. Lowe will obviously have his tenure extended. But anyway, hopefully they have learned from this lesson. And as I said before, if they got in front of the problem earlier, like in mid-2021, we wouldn't necessarily be anywhere near as bad as where we are today. But it is what it is. Look, they're the only questions that we've had come through. We might just give it one more minute in case there's another questions come through now. If and when do you see labour shortages to improve? Look, it's a great question because whilst we've had inflation at record highs in 30 years, whilst we've had cash rates starting to increase, we haven't really seen that affect the employment market yet. From the work that we've done on this, what we've seen is that obviously migration in Australia has really dried up in the last couple of years, particularly across specific industries such as hospitality. We've had a number of our clients and investors say to us of late that the service in hospitality venues has really declined since COVID. And the primary reason behind that is because historically you had a lot of migration into those industries. When COVID hit, a lot of those workers were required to go home. So you actually, we think unemployment being as low as where it has been a little bit misleading because of migration. What we think going forward is as this margin pressure starts to come into businesses, and you're starting to see that, so as rates have gone up, costs have gone up for businesses as well, you're going to actually start to see unemployment rise, migration or not. So as a result of that, the old adage of, employing 3 people for 2 jobs, which is probably where the labour market's been over the last few years, it now looks like it's going to be 2 people for 3 jobs. And we think the actual labour shortage crisis that you've experienced in certain sectors of the economy over the last 2 years will reverse over the next sort of 6 to 12 months, and you'll have mean reversion, as we spoke about before.
That's probably, we've actually gone just a little bit over time. So if there's no more questions, I think we could draw it to a close. As we said at the start, we will be sharing the presentation with everybody who registered to attend. If you've got other questions or you want to have a discussion about the fund or any aspect of what we've spoken about today, please feel free to reach out to us.
Thanks everybody for your time today. And again, we appreciate your ongoing support. And as Michael said, any questions, just please reach out. And thank you again for attending.